There is a version of you that works every single day of your life and dies with almost nothing. Not because you were lazy. Not because you made bad choices. But because no one ever told you which game you were actually playing. Here is a number. 78%. That is the share of American workers who live paycheck to paycheck. Not minimum wage workers. All workers. People with degrees. People with jobs that sound important at dinner parties. And here is the thing that keeps me up at night about that statistic. Most of those people are not broke. They are earning. Some of them are earning well. But they are stuck on a treadmill that was engineered to feel like progress. Meanwhile, somewhere in the same city, someone else is asleep. Their money is working. Their assets are compounding. Their lawyers are billing. And they will wake up wealthier than they went to bed without doing a single thing. This is not a story about rich versus poor. It is a story about 7 completely different financial realities that most people never even know exist. 7 levels. And almost everyone is born into level 1, given no map, and told to figure it out. Today we are going to draw the map. Before we get into the levels, I need to establish something uncomfortable. Wealth is not a number. It is a system. And different systems have completely different rules, different vocabularies, and different timelines. The reason most financial advice fails is that it teaches level 2 thinking to people who need level 3 strategy. Or worse, it teaches level 5 tactics to people who have not survived level 2 yet. You cannot skip the levels. Not really. But you can understand all 7 of them right now, today, which means you can look at your own life and see exactly which level you are on, why the walls feel so high, and what the actual door out looks like. One more thing before we start. These levels are not arbitrary. They map onto something real. Each level represents a fundamentally different relationship between you, your time, and your money. On the lower levels, you sell your time for money. On the middle levels, you make your time more valuable. On the upper levels, money generates money without your time at all. And at the very top, you do not just own money. You own the system that produces it. Let us begin. Level 1. Survival. You are here when every paycheck disappears before the next one arrives. Housing. Food. Transport. Maybe a phone bill. Nothing left. Zero buffer. The math is perfectly brutal, income minus expenses equals 0. Sometimes minus. If you have ever checked your bank account before a transaction hoping the numbers work out, you know this level. What is important to understand about level 1 is not the emotion of it. Everyone talks about the emotion. The anxiety, the shame, the impossible choices. All of that is real. But the mechanism is more interesting than the feeling. Level 1 is a cash flow trap. Every financial emergency pulls you backwards, and because there is no buffer, emergencies hit with full force every time. The car breaks down. The medical bill arrives. The deposit is due. And each of these events does not just cost money. It costs future money too, because you borrow at terrible rates, delay other payments, or make decisions under pressure that compound against you. What keeps people in level 1 is not moral failure. It is liquidity. You cannot save when your expenses consume all inflow. And the brutal irony is that being poor is expensive. Bank overdraft fees. Payday loan interest rates that run 300% annually. Higher insurance premiums. Late fees. The financial system charges the lowest earners the highest prices for the same services. The exit from level 1 is not inspiration. It is the first dollar of slack. A small reduction in fixed expenses. A single extra income stream, even small. Something that creates even $50 of breathing room per month. That breathing room is the seed of everything else. Level 2. Stability. You reach this level when you stop bleeding. Income exceeds expenses. Not by much. But by enough to build what every financial educator in the world will tell you is the single most important thing you can do before anything else. An emergency fund. 3 to 6 months of living expenses. Sitting in a savings account. Doing almost nothing. This is the most psychologically underrated financial move on earth. Because what it actually does is not save you money. It changes your decision-making. When you have a financial buffer, you stop making fear-based choices. You can turn down the bad job offer because you have runway. You can negotiate. You can wait. You can choose. Stability is where most financial content begins. Budgeting apps. Spending trackers. The latte conversation that has now officially been declared dead by every credible economist. And to be fair, those tools are real and they matter. But here is the subtle trap of level 2. Stability feels like arrival. You stopped drowning. You stopped panicking. Your account does not hit zero anymore. And for someone who was at level 1, this feels like success. And it is. But stability alone does not build wealth. It builds safety. Which is valuable and real. But the money sitting in your emergency fund is losing value every year to inflation. Safety costs you growth, which is fine as a temporary trade-off and catastrophic as a permanent strategy. The people who stay at level 2 forever are not irresponsible. They are comfortable. Comfort is the most underestimated trap in personal finance. Level 3. Accumulation. This is where the game actually starts. Level 3 begins when you start investing. Not saving. Investing. The difference is the relationship with time. Savings preserves value. Investment multiplies it. And the multiplier is not talent or knowledge. It is time, combined with compounding. Here is the math that should genuinely rearrange how you think about this. $100 invested at the average historical stock market return of roughly 10% annually. After 10 years, that is $259. After 30 years, it is $1,744. You put in 100. You pulled out 17 times that. And you did nothing. But here is where the story gets interesting. The person who invests $1,000 a month starting at age 22 ends up with approximately $3 million by retirement. The person who invests the same amount starting at 32 ends up with around $1 million. Same money per month. Same rate of return. 10 years of difference. $2 million gone. Not lost to bad investments. Not stolen. Just never created, because the compounding window was shorter. This is why the financial industry tells young people to start investing immediately, and they are right, but they rarely explain the actual mechanism. It is not that young people have more energy or time to research stocks. It is that they have a longer compounding runway, and that runway is the most valuable financial asset they will ever own. And it expires in real time whether they use it or not. Level 3 is also where most people hit a critical fork in the road. Passive investing, index funds, broad market exposure, low fees. Or active investing, stock picking, individual bets, chasing performance. The data on this is not ambiguous. Over 15-year periods, roughly 90% of actively managed funds underperform their benchmark index. Not some of them. 90%. Yet trillions of dollars sit in high-fee active funds because the story of beating the market is more emotionally compelling than the reality of matching it. Accumulation is a long, boring, unsexy game. Which is exactly why it works. Level 4. Leverage. Now the rules change. At every level before this one, you were building with your own money and your own time. At level 4, you start using other people's money, other people's time, and other people's skills to generate returns that your own resources could never produce. The first form of leverage most people encounter is a mortgage. You put 20% down. The bank lends you 80%. You now control 100% of the asset. If the asset goes up 10%, your personal return is not 10%. It is 50% because you only put in 20 cents of every dollar. This is leverage. And it is also how the same mechanism that builds wealth can detonate it, because if the asset drops 30%, your equity does not just drop proportionally. Depending on the structure, it can be entirely wiped out. But leverage goes well beyond real estate. Business leverage means hiring someone who generates more revenue than their salary costs. Operational leverage means building a system, a process, a product that continues producing value without additional labor. Information leverage means knowing something earlier or more deeply than the market does. The uncomfortable truth about level 4 is that it is where inequality genuinely accelerates. People with capital can access leverage cheaply. A wealthy investor borrows at 3% and earns 12%. A poor consumer borrows at 24% on a credit card to smooth over a cash flow gap. Same financial instrument. Completely opposite outcome. One person is using debt as a tool. The other is being used by it. Level 4 is also where most people get in serious trouble because leverage amplifies everything. The wins feel like genius. The losses feel catastrophic. And the financial industry is very good at showing you the wins. Level 5. Multiple income streams. At some point in the wealth-building journey, a single income stream, no matter how large, starts to feel like a vulnerability. A job is a single counterparty risk. One employer decides you are not necessary and the whole thing collapses. Even a successful business is often dependent on a few key clients or one market. Level 5 is about deliberately constructing a financial life where income flows from multiple independent sources simultaneously. The wealthy do not have incomes. They have portfolios of incomes. Dividends from equity positions. Rental income from property. Royalties from intellectual property, a book, a patent, a song, a brand. Revenue from a business that operates without requiring your daily presence. Consulting income from specialized knowledge. Interest from lending capital. Return from private equity stakes. Now here is the subtle point that most people miss when they read a list like that. These income streams are not equally valuable. A job produces active income, which is income that stops when you stop. A dividend produces passive income, which continues regardless of what you do on Tuesday. The goal of level 5 is not just more income. It is shifting the ratio from active to passive. And the reason this matters is not just comfort or security. It is what happens to your time when the income does not require it. Free time, combined with capital, is how you build to the next level. There is also a tax dimension that most people at this level start to understand in uncomfortable detail. Active income in most developed countries is taxed at the highest marginal rates. Capital gains are taxed at lower rates. Qualified dividends, often lower still. The tax code in the United States, the United Kingdom, and most major economies is structured in a way that systematically advantages passive income over earned income. Meaning the person who works for their money pays a higher percentage of it to the government than the person who lets their money work for them. This is not a conspiracy. It is written directly into the tax code, and it has been there for decades. Level 6. Building the machine. This is where we leave the territory of personal finance entirely. Level 6 is not about managing your money. It is about building an entity, a company, a fund, a platform that generates wealth independent of your personal involvement. The entity has its own income, its own employees, its own assets, its own momentum. You created it. But it no longer needs you to run in order to run. This is the level that creates what economists call the separation of ownership and control. You own the machine. Others operate it. And the machine produces returns that are orders of magnitude larger than any individual could generate through their own labor. Think about the math of this. A person earning $100,000 a year, investing aggressively, can build meaningful wealth over decades. A person who builds a company that employs 50 people and sells it for $10 million has accomplished in a compressed timeline what would take a salaried career 2 or 3 lifetimes to approximate. The vehicle here can be a traditional operating business. Or a media empire. Or a real estate portfolio that is managed professionally. Or a private equity holding company. What they have in common is that the income is institutional rather than personal. And here is the irony that people at level 5 often miss. You do not have to be exceptional to build to level 6. You have to be systematic. Most successful entrepreneurs will tell you, if they are being honest, that their success owed more to timing, positioning, and persistence than to genius. The machine does not require a brilliant inventor. It requires someone willing to build a system and then, critically, let it run without needing to touch it constantly. The psychological challenge at level 6 is enormous. Letting go of control. Trusting others to execute. Accepting that the entity has a logic and a life beyond your preferences. Many talented people who reach the edge of level 6 cannot make that transition, and they stay at level 5 permanently, trading their time at a very high rate but never actually escaping the trade. Level 7. Owning the system. We need to be honest about something before we discuss this level. Most people will never reach level 7. Not because they are not smart or not disciplined, but because level 7 is not about personal financial strategy. It is about structural power within the economy itself. Level 7 is when you stop participating in the financial system and start shaping it. This means owning banks. Owning the infrastructure that other businesses depend on, insurance companies, payment networks, commodity supply chains, media distribution platforms. It means having a large enough capital base that your investment decisions move markets rather than follow them. It means having institutional relationships with governments, central banks, and regulators that give you advance access to information and decision-making that others never see. The numbers at this level are so large they lose meaning. The average person can intuitively understand the difference between $1,000 and $10,000. The difference between 10 billion and 100 billion is literally beyond human cognitive grasp. And yet the strategies that govern those sums affect everything below them. Interest rate policy. Credit availability. Which industries receive capital and which are starved of it? Which neighborhoods get development and which get disinvestment? What level 7 reveals is that the financial system is not a neutral playing field. It is a designed environment. And the people at level 7 did not just win the game. In many cases, their predecessors or they themselves helped design the rules. The board that determines what counts as collateral. The legislation that governs what financial instruments are legal. The accounting standards that determine what looks profitable. This is not a critique necessarily. Systems need designers. But it is a fact that is rarely discussed when we talk about wealth, because acknowledging it reframes the entire conversation. Climbing the levels is real. People do it. The path we described is real. But the shape of the mountain was not determined by nature. It was built by someone.